We don't need a huge amount of like forward guidance or anything. It would just be nice to know like what's the reaction function. I think that there's a difference between those two things. What's the reaction function? And then in this particular circumstance, given the sort of the announcements and the rhetoric coming out of the Treasury and Secretary Bessent, it would be good to have a clear signal that the Fed frankly is gonna do its job, and I think that will help the long end of the curve. One of our big calls has been that if Warsh does not sound sufficiently hawkish, then the long end of the curve is going to ask for compensation. And there have been now moments when it appears that the Treasury is not going to be happy with that market signal, despite the fact that that's exactly what Warsh has asked for, to hear the signals from the market he's asked for. And when we see that kind of signaling, it's not so much the numbers or exactly what they're doing at this moment in time, but that kind of signaling is just sort of not helpful. We see that increase in yields and decline in the dollar that we don't really like, and we would like to hear from I would like to hear from the Fed. I think institutional investors would like to hear from the Fed. Is it gonna perform according to its mandate?
For Warsh, sounding hawkish may not be the problem. I mean, he's sounded pretty hawkish ever since he took the reins as Fed chair. It's the lack of clarity on how the Fed would move forward if inflation does not come down. That seems to be what investors really want some kind of insight into. And his reluctance to share that, is that something that investors will just need to get used to, even with the Treasury market perhaps not sending clear signals because of intervention from Bessent?
Right. So we need to know what the reaction function is. It's exactly as you say. We need to know what the reaction function is. I think what I'm worried about is, if Bessent is trying to send a signal to bond markets and then we don't get this clarity from the Fed, not necessarily today, but over a period of time, and particularly as the labor market reaccelerates on the back of this kind of broadening out of profits. It may be that there's a soft patch in the short term, but eventually this is an economy that is going to see a reacceleration in the labor market that will provide clear evidence that rates are in fact not restrictive. And we need to know that there is a Fed there with a reaction function that is the same as the one that we're all used to, and that will sort of tighten if those things happen. And if we don't hear that kind of a signal, particularly if the labor market starts to reaccelerate, then I think there is going to be a battle at the long end of the curve, and that's just not something that's really good for anyone.
Well, Freya, I think maybe Fed Chairman Warsh, she's kind of saying, hey, the market's full of adults. You guys can figure it all out. We don't have to hold you by the hand. And maybe that's kind of what we're seeing here, because we've got the 10-year rate at almost 470. The 30-year at 520. The market's kind of telling the Fed, we got this. Is that enough?
Yeah, as long as the rest of the administration is prepared to hear the signal. Personally, I think that the 10-year has not yet fully priced this new macroeconomic regime. In terms of the signals that are coming out from the Treasury, I would be much more interested in sort of pro-cyclicality of fiscal policy than I am in any kind of liquidity, so-called liquidity interventions at the long end of the curve, which in my mind can only really cause temporary effects. I'm much more interested in pro-cyclicality of fiscal policy, the extent to which it might be contributing to inflation being above target, and the greater likelihood of these negative supply shocks, such as the Strait of Hormuz, such as tariff shocks, which destroy the hedging or reduce the hedging capacity of bonds for equities, turn that correlation positive, and therefore term premiums should be higher. So 4.7 on a trend basis for me is not yet high enough.
Interesting. Well, this feels like the high water event for this week. We had NVIDIA earnings, which kind of pointed to inflation, given what NVIDIA said about the supply chain issues that it faces, the logjams. And then you have Kevin Warsh's speech. Next week, at least in the U.S., it's the final week before a three-day weekend, and it feels very much like there's going to be an absence of participants in the market. I mean, we get some big data points, but who's going to be around to respond to it? What are you looking for next week that could really move things along and give us some more direction on the state of the economy? Is it just all going to be about the jobs report?
The jobs report is always important, but there's so much noise in these data. I think there was a lot of upside noise, probably both in inflation and jobs data early in the year. There may be some kind of strange seasonal pattern that's kind of coming into that. Then there's been a bunch of probably downside noise to correct that. But the trend for us is upwards. And the point about Nvidia and these earnings. We are seeing that the effects of AI are much more coming through on the demand side and the inflationary side so far than on the diffusion side, which is not to say that they won't come through on the supply side and the diffusion side. But right now, it is much more an inflationary effect, both through the direct demand and through the spillovers that is creating, in my mind, positive spillovers to the rest of the economy and broadening out of earnings, which is a forward signal for a reacceleration in the labor market. But then the question is, what else is the administration doing with regards to the supply of labor and the ability of the rest of the economy to keep up with that demand pressure, particularly if the equity market is performing well and that creates positive wealth effects at the same time, which again is a more sort of diffuse form of demand creation. So we've got a lot of demand creation and not so much ability of this labor market to respond to that supply. I think what we're going to see is a pickup in unit labor cost growth and probably also a pickup in the markup from unit labor cost growth to CPI and core services inflation in the US, going back to a sort of a pre-globalization, pre-deleveraging type of a relationship there. And that's very much sort of all to come. So I'm focused on the earnings. I'm less focused on sort of one data point of kind of inflation or the jobs market. And I think that is the trajectory for a lot of the FOMC members as well.